All right, so the presentation I'm going to give today is aimed at providing an overview of what mining is, more than just a high level of it's printing money, for people that are maybe involved in Bitcoin in some other aspect and want to know exactly what's going on with mining and how it works. So we'll cover some core concepts and then get into some of the more technical components. So obviously we know Bitcoin's a decentralized digital currency that enables instant payments to anyone, anywhere in the world. And it works using public key cryptography, peer-to-peer networking, and proof of work to process and verify transactions. So what is a transaction? A transaction is the mechanism for sending or transferring Bitcoins. In a transaction, an owner of Bitcoins can send Bitcoins from an address that they control to a third party, and that's how payments get made or values transferred from one party to another. A transaction has to be valid in order to be accepted and recorded in the blockchain, and a properly structured transaction is generated by the wallet that you're using and will include elements like the sender, I am the sender, I want to send X number of Bitcoins to recipient defined by this address, here's the amount, and here's my digital signature proving that I am who I am. I am who I say I am. They're initiated through a wallet. So if you download a wallet or use an online wallet, when you go in there and you want to send Bitcoins to somebody, you're essentially initiating a transaction. And the purpose of initiating the transaction is you format it, it gets broadcast to the network evaluates it to make sure that it's properly formed and that you have the Bitcoins that you say that you do. It's then loaded into the blockchain. So when we talk about the blockchain, it's literally a chain of blocks. So what is a block? A block is a bundle of transactions, and blocks are formed by compiling the most recent valid transactions into a structured data set to be recorded in the blockchain. So as of right now, we have a certain block that is the last valid block in the blockchain, and there's transactions that are occurring right now. As those transactions are relayed to the network, they're validated, and then they're bundled up into a block, which then becomes the next block in the chain. And when you look at a block structure, this is an example of a block structure, and it shows we've got the version at the top, the previous block hash, the Merkle root timestamp, bits, nonce, and then a bunch of transactions. So there's a header basically saying that this is the number that corresponds to this particular block. There's a reference to the previous block and all of the transactions that are part of that block. So the blockchain is a distributed database containing the complete record of all the transactions starting with the very first block, the Genesis block, which was the first 50 Bitcoins that Satoshi Nakamoto mined and got this whole thing started. The blockchain resides on thousands of nodes throughout the world and ensures that everyone has a consistent view of the complete transaction history of Bitcoin. The shared ledger ensures that all Bitcoins are accounted for and prevents double spending. So every single transaction that has ever occurred with Bitcoin is recorded in the blockchain. You can trace any Bitcoin you have back to either its creation in a Coinbase transaction through mining or being transferred around from different parties. And if you go, I'm sure many of you have seen the website blockchain.info or .com. So you can see blocks being mined in real time there. And so over on the left, you've got the block height, which shows the number, what number we're on, the time that it took to mine that block, how many transactions are in it, which pool relayed that block. So the top one we've got there, it was mined in 1 minute. So essentially discus fished that pool, bundled up all the transactions that occurred after the previous block. That was 190. They solved the block, relayed it to the network, and it got validated and now is part of the blockchain. So what is mining? Mining is the process of spending computational power to construct valid blocks, generate proof of work, and submit to the network for inclusion in the blockchain. So the purpose of mining, and this is part of the genius of Bitcoin in general, the Bitcoin protocol was designed so that there would always be an economic incentive for miners to exist and contribute the massive computing power required to secure the Bitcoin network 24 hours a day, 7 days a week, 365 days a year, and ensure that transactions could be processed on demand. So if you think of the banking system, it's obviously we've got computers all over the world connected and able to facilitate any function that needs to happen to support the banking system. If you're going to have a currency, you've got to have the same type of infrastructure that's always on demand. And so by creating an incentive-based protocol, that's how the problem of making sure that there's enough computing power there to allow the Bitcoin network to function. And obviously, the rewards is a big reason why miners are involved. So miners are rewarded in Bitcoins and transaction fees upon acceptance by the network of a submitted block. This is also how new Bitcoins are generated through mining. Approximately every 4 years, the reward is cut in half. So the current reward per block is 25 Bitcoins. When things first started, the reward was 50 Bitcoins per block. Current value is simply you take the 25 Bitcoins and multiply that times whatever fiat exchange rate you want to look at. In dollars, the current reward is about $16,000 per block, $16,250 based on like today's exchange rate in US dollars. Since transactions can only be included in a single block and there's an economic reward associated with mining, it's a very competitive and increasingly difficult race. So I know some of you are probably in the session beforehand and heard them touch on the competition. It's very competitive. There's a reward to be had. There's obviously money, and so it's like an arms race right now. With as new hardware hits the market, it becomes increasingly difficult, and your return essentially goes down with every difficulty adjustment, which happens every 2016 blocks. So the profitability is determined by the cost of the hardware, your cost of electricity, your hashing power, and the value of Bitcoin. It was interesting because we had a bunch of hardware that we received when Bitcoin was a lot lower dollar value and thought, well, this is not going to make any money, and then it spiked to like, hit 1,200 and things looked a lot better. And I think even, there's people that probably take a calculated risk now because they want to mine Bitcoins, and even they know it's $500 or $600, but they believe that its future value is going to be much higher. So that calculation is really, up to the individual to make, and there's a bunch of assumptions you have to make to get there. But essentially, you've always got to look at the hardware cost, electricity, hashing power, value of Bitcoin, and that'll tell you whether you're going to be profitable, and you can get a reasonable expectation of how long the mining hardware will actually return a profit. Every 2016 blocks, the Bitcoin protocol takes a look and makes an adjustment to ensure that the rate of creation remains at approximately 1 block per 10 minutes. Technically speaking, mining is the calculation of a hash of a block header. So, and we'll look at one, which includes, among other things, a reference to the previous block, a hash of a set of transactions, and a nonce. So this is like the real work when you ask, okay, what the heck is the actual calculations that a miner is doing? It's calculating a hash of a block header. And the reason it's difficult is because the SHA-256 hash of a block's header must be lower than or equal to the target in order for the block to be accepted by the network. The hash of a block must start with a certain number of zeros. The probability of calculating a hash that starts with many zeros is very low. Therefore, many attempts must be made in order to generate a new hash. We're going to look at exactly what the math looks like. And if you want to understand in detail more about the proof of work, which is essentially what this is, it's a proof of work concept that essentially requires a certain amount of work to be done in order for it to be valid. That's probably a good place to go and learn more. Cryptographic hashing it's really a pretty simple concept. A cryptographic hash function is essentially a hash function that takes an arbitrary block of data and returns a fixed size bit string, the cryptographic hash value, such that any accidental or intentional change to the data will with a very high probability change the hash value. And you can see that here. So if you were to hash the string, the quick brown fox jumps over the lazy dog, I don't know if that's an actual correct hash or not, but I pulled it from some other stuff, so I think it is. But the point is, if you look at that, so you take that string, you run it through a hash function, and it returns this string of seemingly totally random characters. Now, if you change that string by one, just by adding a period at the end, so you see in the second it says the quick brown fox jumps over the lazy dog, period, it doesn't give you anything that's predictable. It gives you a totally random hash. It's totally different. And those are abbreviated, so those are 256 characters. And so what a miner's doing is taking certain pieces of information which are represented in the block headers, so and other information. So they take the information, including a reference to the previous block and some other attributes, like all the transactions. Now you've got a chunk of data, and you run the hash function. If there's enough leading zeros in the result, then you've essentially met the criteria for a valid block. And so you can imagine, if you're looking here, the probability of getting a 0 is 1 in however many, and then it gets incrementally or exponentially harder to generate a hash with a series of zeros, like 15 zeros. I mean, like you're talking trillions and trillions of tries, and it's a scenario that is that's essentially what secures the Bitcoin protocol. That's why it's so secure, because the amount of computing power it would take to essentially hijack the blockchain it would cost I don't know, they say, I don't know, maybe close to $1 billion now to hijack it, because of the amount of computing power it would take to make all the guesses required to hijack the blockchain and essentially fake it and take it over. So when I mentioned the components, when I mentioned a block header, so for every block you're going to have certain information, and in this right here we've got the version, we've got a previous block hash, and if you notice where it says previous block hash, it's reversed, but you see all the zeros at the end. Everybody see that? And so the difficulty, when people talk about difficulty, the difficulty is essentially telling you how many leading zeros you need to have in the hash that you generate, and that creates the target. And as a miner, you're always trying to find a hash that's below the target, and the target's defined as a certain number of leading zeros on that hash. So you keep going and going and going until you get one. You say, oh, look at this, I happen to find a hash with 15 leading zeros. You've got the timestamp, the bits, and the nonce. And the nonce is the key variable that, when taken in conjunction with all the other variables in the block header and run through the hash algorithm, generates a particular hash. And so the nonce, as a miner, you'll use that number 487-50833 in the calculation. You'll see if your hash is lower than the target. If not, you increase the nonce to 487-50834. You run it again. You see, did I get enough zeros? And on and on. And so you're talking, lots and lots of computing power in order to guess a hash that has that many leading zeros. It's a lot like a lottery. So quickly we'll run through the hardware and software just to give you an idea of what's required to mine. Hardware, you've got a specialized device. It generally consists of, at minimum, a printed circuit board. Today, ASIC chips, power supply, a cooling solution, and then a standalone or rack-mountable case. In the early days, you could mine with a CPU, and then as things got more difficult, people started realizing that they could be more effective using a graphics card, so GPU mining. Then we had FPGA, which is using field programmable gate arrays, and then ASICs, which is the most recent generation of mining gear. That stands for application-specific integrated circuits. So they're chips that basically do one thing, which is run the hashing algorithm. And all of the manufacturers are competing essentially to build better ASICs, to build chips that are both efficient and don't use, the lower the power consumption, the less heat you generate, the better. And then a lot of the other stuff is kind of generic. I mean, we have a lot of boards that we've played with because we're interested in the energy aspect of things, and so we've played with all kinds of different cooling solutions. Everything from we haven't done any submerged liquid cooling like you might have seen ASIC miner doing, but miners are pretty interesting in terms of all the tools they've used to accomplish the tasks of managing the heat and getting their chips to perform faster. Because basically you've got a chip that's designed to operate at a certain voltage, at a certain clock rate, and the more you can push it, the more money you make. So you've got this incentive to figure out how to keep it cool, how to push it as far as you can, and there's a lot of ways to do it. Software, you've got board firmware. So if you've got a board, whether you buy it from a manufacturer or you are brave enough to try and design one, you're going to have board firmware that essentially routes the instructions and regulates voltage and things like that. You have the mining software like CG Miner or BFG Miner. So the firmware is something that you really don't see. And then you take a board, connect that to a controller. A controller could be a computer, it could be like a Raspberry Pi or some other device running Linux usually. And then on that controller you're going to have CG Miner, BFG Miner. There's some other mining software, but those are the main ones. And then you have a wallet so that you can store the rewards that you generate as a miner. And then monitoring software. One of the things that we've done is we bought an application, a platform mining monitor, and that's another key thing is having some sort of way so that you're able to actually monitor your miners if you've got more than one particularly. Pools. So in the early days, you could actually fire up your computer and mine bitcoins. These days, if you were to fire up your computer and try and mine bitcoins, it's probably not going to happen before we see dinosaurs or something again. So the way most of it works these days, people join a pool. So instead of, even if they've got a significant amount of hashing power, there's usually going to be a strategy to hook up with pools. Pools, it's just what it says. You're basically pooling your hashing power. And the pool's like the traffic director. The pool is going to monitor the blockchain, and whenever it recognizes that a new block has been solved, it's going to relay a message to all the miners and say, hey, the block's been solved. Here's the new block. Here's where you need to start running your machines. As a miner, you're submitting your calculations back to the pool to verify that you're connected and that you're actually doing the work. And then when somebody within the pool finds a block, it gets split among all the parties. One of the key things to watch with the pools is you've got to understand what the payment structure is. Some of them are simpler than others. Some will just pay out a pro rata share based on the computing power. Some will weight the shares based on how long you've been participating. Some will divide it over a bunch of rounds. But it's all essentially a way to pool computing power so that instead of having to wait, 3 months to hopefully find a block, you can contribute a little bit of power knowing that, all right, we're all going to put our computing power together and we're going to split the rewards among us. Kind of like a lottery ticket buying pool. Quickly, the process to go from a block to a dollar, pool rewards. So if you've got your mining hardware set up, you're going to connect to a pool. The pool is going to transfer rewards that are due to you to either a hosted wallet or a private wallet. From there, miners can transfer Bitcoin to one of many exchanges where Bitcoin can be exchanged for fiat. So you definitely don't want to leave your money sitting on a pool, just like you don't want to leave your money sitting at Mt. Gox. And so most often you're gonna set it up so that you're automatically having your rewards pushed out to a private wallet, and from there you can do whatever you want. I mean, you can then push it into an exchange if you want to convert it to cash, and from there you can withdraw it to a bank account. You can use it to buy things, and so that's it. I mean, that's really the process. The reason people are I know one of the reasons that people like mining is because it is a way to acquire Bitcoins that's private, as opposed to going and having to disclose all of the information to and jump through the hoops required with certain exchanges. But in order to get it back out, you're still going to have to go through some conduit or do some sort of person-to-person exchange. And I hope all of that made sense. I'd be happy to answer some questions as long as they're not too difficult.
I'll take the first question, if you will. St. Clair, you heard earlier in the earlier session, a gentleman got up and asked a question. If the average guy wanted to start mining and he had the technical knowledge to do so, he got into ROI. If somebody went out and if you can go back to that slide that had equipment on it. Purchased, let's pick a number, say $10,000 worth of equipment. Hardware and software, yeah, there you go. A6 chips, the power supply, the cooling station, the rack, and exclude from my question the cost of the electricity. Let's just say that's part of the overhead in the facility you're already in, and it's going to be recouped. It's going to disappear. What would be the ROI at today's rate? Let's use 650 or 600 to make the math easier. The ROI and the time to recoup that $10,000. And I know it's a bit of an unfair question, but based on today's dynamics.
Well, the true answer is there's no way to know that you ever would.
Well, you're going to get you're going to mine.
Are you saying if you assume that the exchange rate stays at 650?
Sure.
You'd have to know what's the performance of the hardware you're getting, and I mean.
I'm trying to fit that into 10. I know it's a unfair question.
Let's see. What are those Bitmains going for now? They're going for they got 180 gigahash miner, 200 gigahash miner for how much? $750. So that is let's see here. If you want to do some math, we'll do it.
See what the rate, the time frame for someone who's just walking in the door and never heard of this before. He's going to have the question, how many Bitcoins or altcoins, I know now that throws another kink in the question, but how many, at what rate would you be mining the BTC based on whether it's a $5,000 or $10,000 investment or even more, just some.
So that's like $4 a gigahash, and it's pretty questionable. The key is to figure out, that's the thing you want to get to is what's the price per gigahash of the hardware. Yeah.
Well, true.
Yeah, I wouldn't even go there, unless you can know that it's available. yeah, you don't want to pre-order any hardware unless you've got a lot of money to burn. Now,
Go to the Genesis block as well. It's kind of doom and gloom. It doesn't put in a lot of consistencies. Like difficulty has jumped. It's at 3.8 billion right now. It's jumping up to 3.9 billion, which is lesser steps. So it's all variable. You know, go put it more into it than you can afford.
yeah, don't put more into it than you can afford to lose. That's what you're saying, basically. I know. I mean, you know, the thing is, the level of talent you can recruit also, I think, you know, has a big impact on it. You know, we bought a bunch of chips, and we, quite honestly, I didn't know exactly what the hell I was going to do with them, and I got lucky in that I partnered with a good PCB designer and firmware guy, and our stuff worked. And so we rolled the die. It was a calculated gamble, but we couldn't get our hands on hardware, but we were able to get our hands on a bunch of chips. So we bought a bunch of chips, and we built some custom boards, and they worked. And there again, you know, I was pretty nervous when Bitcoin was not worth very much, and people were like, "You're doing what the hell are you doing again? I don't understand." Okay, so based on a hash rate of, let's see, 180 gigahash at 668. Let's see what that tells us. So per month right now, it says $482. So that doesn't look too bad. I mean, I would never probably invest in hardware that didn't look like it would return all of my investment, you know, within 60 days or so.
Right.
Personally, you know, I mean, but you kind of got to make a decision, you know, on what your fundamental belief is on the value of Bitcoin. I mean, I don't really, I see it as something that's definitely in my view, it's going to go up from here. I don't see this. I see this as more of a floor than anything, and I think that if you truly understand, I mean, like with GOX, I mean, it really crushed the market for a day or two, but that was not news. The only people it was news to was like the Wall Street Journal and all these reporters that, you know, wrote this idiotic stuff. So that was the buying opportunity. If you truly understood nothing fundamentally changed except for headlines that said Bitcoin went bankrupt, you know. So if you have a fundamental belief that there's going to be value, you know, they're going to be valued at, you know, $3,000 or $5,000 at some point, and you can make that calculation, then by all means do it. But, you know, it could go to zero, I guess.
What do you think about government intervention, especially the U.S. government?
It's interesting because I started an energy brokerage business in 2001 when the market deregulated in Texas. And so we went through this process where it was the Wild West, and then we got to a point where all of the serious brokers got together and said, hey, there's a bunch of bad guys that are making us all look bad, so maybe we should sort of self-regulate and kind of agree to some common interests, agree that we're going to transact in a certain way so that we can head off some of the regulatory threats to our business. And so I've experienced another industry that went from regulated to deregulated, Wild West, to a group of the industry players getting together and pretty much self-regulating. And so in Texas, they've never really come down and decided that they needed to regulate us. So, you know, having that experience and hiring a lobbyist, you know, one thing we realized is that people didn't know anything about what we were doing for years. I mean, it was 5 years into it before we hired a lobbyist, and none of us individually would have hired a lobbyist, but as a association, we spent the $50,000 a year or whatever in 2009 to send a lobbyist to the Texas state legislature because we didn't have a voice. And so I think that, you know, it's one thing to cave and say, oh, let's just let the government come in here and take over and write the rules. And it's totally different to recognize that most of these lawmakers, Joe Manchin, for example, they don't know what the hell this is, you know. And so part of our job is to engage and make sure we educate them so that bad legislation doesn't get slipped through. In the energy business, there was Illinois opened, and there's one company that basically they had all the pull with the legislators, and they pushed through some really bad legislation that totally went against, the kind of the spirit of deregulation. And so I think we got to be careful, because we don't want something to slip through that we weren't prepared for. And the only way to make sure that doesn't happen is to have a seat at the table, so that we can, and like we looked at it in terms of, okay, we're not really trying to change or write laws. We just want to, this lobbyist is an insurance policy. We need someone down there in Austin, so if any bill comes up that has the word electricity or brokerage or consulting, she reports back to us. We decide if it's something we need to take action on. And so it was an insurance policy. And then by the time the next session rolled around, we were a known party. So the legislators actually knew, hey, these guys represent, in fact, like the brokers in Texas, it's over a $25 billion market, something like that. And we represent over half the customers. So we are the customers. And so the legislators realized that if they wanted to go talk to the market, they could talk to us, and we could basically speak for them. So I think that it's something we have to deal with. I'm not really, I'd say I'm a libertarian, if anything. So I like less intervention.
Most of us are.
Yeah.
Did you have a question? Come on up, please. We'll follow it up with a question.
No, it does have a question. My name's Eric. I've been consulting for large-scale data center builders and operators, and I did a model about 3 weeks ago for a potential customer, which is a miner, and at about 0.5 megawatt of mining cards, or 480 kW, based on, let's call it 1,000 kW nodes, which is a couple cards. It yielded about 0.5 petahash, and there was, if everything was prepaid over 12 months, there was about $5.5 to $6.5 million investment. Half of that was data center costs for base rent, cooling, power. The other half was cards, mounting systems, to kind of build them out in the racks and all that, and the power whips required. And that had a payback, I think, in 3 to 4 months based on some of the website calculators you mentioned. But after 12 months, assuming the level of difficulty didn't change, because I didn't factor that into the quick model I did, it was like 13.6 million in Bitcoin for a $5.5 to $6 million investment. But if we factor in the degree of difficulty based on the volumes of the new mining cards coming out, maybe it's really only good for 6 months. I really don't know, because I haven't modeled it. But that just gives you an idea. If you're a bigger miner,
you
get into the market now,
and that's assuming that the data center will let you come in with some liquid cooling and stuff like that, which I found most of them don't want to have anything to do with that. Yeah. And yes, it's pretty tricky. I mean, that's one of the interesting things, is that we're kind of moving into this industrial scale world, but like the data centers don't want miners in there, because everything that's worth putting in there requires liquid cooling. They don't want any liquid in there. And I mean, then you tell them that, oh yeah, and by the way, this stuff's going to be like not worthless in 6 to 9 months. I'm going to want to move out or tear it out and put it back in. So interesting opportunities.
My question, because I looked at you online, and I think all your expertise is back in the utility markets, buying power and spot market. So one thing I'd like to understand, if you could explain, when a utility offers a spot rate, let's call it 1.8 cents or 4 cents a kW or something, how do you calculate in transmission cost, and do spot markets move substantially? So if you can buy on a spot rate 3 months worth of power, will that rate drastically change 3 months out, or will they keep selling it if they have stranded capacity? And how does it look? Because the pricing on a 5-year contract was like double in some scenarios I inquired in, and then they said there's transmission, and I just don't understand how all those mechanics work.
So the spot rate is a spot, so it's going to change. Like in Texas, it changes every 15 minutes. And the TDSPs are actually regulated, so those can easily be calculated. They're based on your load profile. So as a miner, you're going to get, your TDSPs are going to be as low as any rate class, because you have a very flat load. You turn them all on, they kind of go 24/7, as opposed to an office building where their electricity load, you come in 9 o'clock, it ramps up, 5 o'clock it goes down. So miners are a very good load profile. And I did a presentation in San Jose where I explained how the energy stuff works. But on a spot market can be very good if you manage it. In Texas, you can get 2-cent power, in a lot of places in Texas. The key is being able to identify when the market spikes, you know, to 12, because if you're on a spot rate, by definition, you get the benefit of the very low, and when it spikes and it goes very high, you're going to have to take that too. The interesting thing, and one of the projects we worked on, and we've kind of know how to do it, it's what we've been doing for a long time, is if you build out a mining operation and put it in the right place, you can buy really, really cheap power, and you can also structure a contract so that you can take advantage of the spikes. So when we're getting 1 cent power, we're mining away. And then we would have a calculation that says if the price of the spot market goes above X, then we kick in backup generation, and we could sell power back to the grid, or there's all kinds of ways to essentially monetize the spikes, utilize the low prices, and kind of get the best of both worlds. And Texas is like the best place to do that.
We have time for one more question. Please come up. One or two.
Yeah, and one of the other slides, you mentioned the layers of software from firmware, and you got into pool software. And whereas like CGI Miner is open source, the one.
Yep.
Is all pool mining software proprietary? And there's kind of two parts to that. So one being the actual how it allocates things like internally, and then the second part is when it distributes the rewards, like a trust element to it. Is basically, is there anything out there that protects miners? Let's make sure that their pool's being honest, and like how open is that software world?
So most of the mining software out there is open source, and so you can find there's tons of different versions you can get out there if you wanted to start your own pool. In terms of the payouts, one thing that's nice is that there's always some guy that's like got a calculator and a spreadsheet, and he's calculating down to the Satoshi whether he's been paid properly, and will raise hell if anything looks fishy on the pools, which is why I don't know if I'd ever want to be a pool operator. So the structures are pretty clear. There's paper share, and then where if you want to just eliminate the risk and have a set payment, you can go to BTC Guild and set up as paper share, and they will pay you for every share submitted a particular rate. And so it's real easy. Then there's other models where you're not guaranteed a payment for every share you submit. You're essentially going to ride the wave. So if they get lucky and they solve five blocks in a row, you're going to make more than if they have a day where they're unlucky and they're not solving as many blocks. And so there's hell, I think there's like more than 10 different ways of handling the payouts. And everything is, it's pretty easy to audit. Now, if you've got a whole bunch of the thing where it gets tricky is when you've got a bunch of gear and you don't want to have it all attached to BTC Guild, because maybe BTC Guild gets attacked, and all of a sudden your stuff's crapping out and you can't figure out why, and you're like, well, crap, DDoS attack on BTC Guild, so we can't connect. And then so you got to fail over to Allegis or some other pool, but then like we try and look at, okay, well, what are we getting per gigahash on these various pools, and it's all changing. There'll be hiccups in certain pools, and there'll be latency issues. In fact, that's what we kind of got interested in, was after having all this hardware and trying to figure out how the hell to manage it, was what's every single possible variable that would impact or create an area to optimize mining, because servers are located in different places. If you're mining with certain pools, they may contact you and give you certain IP addresses or ways to connect that they don't disclose publicly, so it may give you some security. But you've got to track it all, and ultimately the idea is to kind of spread it out and mitigate your risks by not having all your eggs in one basket, and then having automation in terms of failing over to different scenarios based on things that are identified.
Time for one last question. St. Clair, thank you. Thank you for spending this afternoon with us.
Appreciate it.